Oh, we're live now. Uh, People are going to be joining in.
Sure.
And so, we're expecting Q2 income stream pretty high. And assuming the trajectory, right, it's going up when it comes to oil prices, then we're probably expecting higher yield in Q3, probably in Q4 dividends. I think
Yeah, I mean, the production side of what we're doing is so predictable and repeatable. You're in the heart of the Permian, right? And these wells are just cash flowing very high volumes, right? Producing very high volumes. And so you're kind of making up for that volatility in price a bit just because the volume is so high and stable, right? So each quarter may be fluctuative, but you look at it over a 12-month return, very consistent year over year.
got it. And with the, and I know we'll talk about this further during the webinar, with this 100% bonus depreciation, that would move the needle in terms of how much depreciation IDC. IDCs are already 100%, but the
Mhm.
non-IDC part with 100% bonus, is that something that would come into play? Is that something that's affecting the overall depreciation that you could take?
It may, right? So we've had a couple funds where it depends on the asset. Like if you're drilling a new well, you have a part of the well that's tangible costs that you can take depreciation on. But the majority of that deduction's on intangibles like fracking, wages, building roads. Now, if we have add pipelines into the fund, right, you can take 100% bonus depreciation, use that on top of your deduction and get a higher um, tax strategy, right, tax deduction. We're kind of toying around with that and seeing is that something that we want to add to offerings on a go forward basis.
Got it. Awesome. I think people are joining in. We'll give it a minute or two, and then we'll start the webinar.
Yeah.
Usually, it's interesting that usually we have a lot of existing clients, people that we have already chatted with at a certain point, so they're probably familiar with me or someone from Valor.
Mhm.
Um, so it's good in that sense that they are very much familiar with the underlying product, and they have very good questions that they ask, which is also a good thing because it keeps us, the whole webinar engaging. We get to share a lot of valuable insights in terms of the underlying product and keep things going.
Yeah, I
So
can
it's
tell when I talk to a client that works with you guys, right? Because they're very educated on the tax planning process, understanding what's out there, right, and ways that you can mitigate your tax bill. But my experience when working with you guys is that your clients are much more knowledgeable about, which is great, right? That's a kudos to you and a kudos to the clients, right? Actually caring.
and that's the whole idea behind all the content that we have written, or all the calculators, all the tools that are in place to make sure people understand the trade-offs between things and can make a better decision, right? Whether it's oil and gas or whether it's something else, right? Just to have everything at their disposal to make a calculated decision, right?
Yep,
Uh,
100%.
I think we should start. We'll have people joining in, but let's just kick off. So thank you so much, everyone, for joining our webinar. Today we'll be talking about oil and gas investments. Oil and gas investments is something that helps solve for ordinary income, right? There's a lot of, and as we're getting into the middle of the year, a lot of people are planning about, they have a big tax bill, they're planning about how they can solve for that particular ordinary income, or how they can solve for the realized capital gains, the stock that you have sold, or anything highly appreciated that you have sold. And for both income buckets, oil and gas is a very good strategy in itself. And that's what we'll be talking about today, right? How it works, what are the risks, and other things. So before wasting any time, I'm your host. My name is Farhan Akhtar. I'm the head of Ordinary Income Planning here at Valor. Been with Valor for 2.5 years now. Most of you probably have already chatted with me at a certain point about either oil and gas and solar. And and very excited about today's webinar. We have our guest, Nick White from U.S. Energy Department of Business Development. U.S. Energy is the leading company when it comes to oil and gas investment, these kind of funds. I'm gonna let Nick introduce himself and U.S. Energy, but thank you so much for taking the time, Nick. I know you're a very busy man,
Yeah.
but really excited to have you here.
No, I'm excited to be here. Thank you for having me.
Yep. Real thrilled to have you. Let's just dive in. So very quickly going over the agenda. So what we'll be covering about first the U.S. energy, and again, a lot of people would be interested in knowing, who's U.S. energy, because when it comes to these kind of investment, there's a lot of faith in the underlying fund, right? How things are structured, mechanics, and everything, and that's why we have Nick here. Then we'll walk them through the oil and gas investment, how the structure itself works, how you make the investment, what are the pieces that you need to think about. And then there's this hot question that I get every day is what is the new administration doing about this? When it comes to renewable energy, right, there are a lot of things, but seems they're very favorable towards oil and gas. So we'll have Nick share insights on what they're expecting, what where currently things are, and then we'll cover the ROI, right? How do you think about oil and gas when it comes to depreciation and income stream, where the commodity prices are volatile? How do you, sort of wrap your head around this? That's what is the baseline structure. And then we'll talk about the benefits and the risk that comes with oil and gas investments, and we'll, walk you through a real life case study to see, how these numbers play out in a real life. And without a further ado, Nick, again, thank you for joining. Why don't you tell us more about yourself, U.S. Energy? What do you guys do?
Yeah, so I appreciate being here and thank you for having me. My name is Nick White, right, Director of Business Development with U.S. Energy Development Corporation. I've been lucky enough to be with the firm for the last 13 years. Right? This is the only job I've had. I think that makes me one of very few millennials that have stuck with one job out of college, and there's no place else I would rather be. Right? My role within the firm is more on the tax planning side of the equation. I know we encourage questions here, and I can tell you anything technical about the oil and gas process that you want to know. How deep do we drill? What type of commodity are we focusing on? But I really like to get hands on with the tax planning side of the equation, right? Educating clients, advisors, CPAs on the oil and gas investment space, or how can high income earning clients utilize this space and create these really unique tax arbitrages, right, on an annual basis. So again, lucky enough to be here. Been here a long time. The firm itself has been around even longer. Right? We were incorporated back in 1980. So we have well over 45 years of experience in offering these type of investment vehicles to the community. And that's very important, right? Because when you're reviewing an oil and gas partner, you want to make sure that they have a long-term track record, right? Oil
Exactly.
prices tend to be rather volatile, right? They go up, down, sideways on an annual basis. And so being able to be in this space for over 40 plus years and offering clients predictable, repeatable returns on top of that deduction is something that we're super proud of. Now we are, I heard you say this, we are the blue chip sponsor in the oil and gas space. Our space on an annual, like last year, let's use 2024, raised right around $1.1 billion of capital. We were responsible for about $700 million of that, right? So something that we're super proud of, that growth that we've seen over the last 40 years, and we continue to be the leading sponsor in the space, delivering these type of vehicles that clients can take advantage of.
That's a pretty big number. And I think I've gone this question before, right? I mean, there's this question, and I think we'll cover this later in the webinar as well. That when you're deploying, right, $1 billion, right, it's not a single well that you would deploy. It's a question of diversification when people think about the income stream and everything. So curious to hear, Nick, when you're deploying this many fund, it's diversified, right? And how many wells and how people should think about it.
Yeah, it's extremely important. I mean, diversification is not just a word that we use in the portfolio of individual investors. It's something that we believe in as a sponsor, right? So diversification in terms of the well count within an entire portfolio. Like our drilling fund, like last year, we have exposure to about 175 wells within that portfolio. So it gives you a massive amount of diversification, right? you never want to be relying on 1 or 5 or 10 wells for your overall rate of return. The more wells that you get, the tighter standard deviation you can expect from a return profile, which is, that comes with being able to raise that significant amount of capital.
Got it. And another question, follow up on that one is that there are a lot of funds out there. When you go and search on Google oil and gas investment funds, you'll see a lot of names pop up. People are doing a very good job at SEO and everything. So you get this question of and there's one thing that you covered, right? The diversification piece, right? What is the difference between I'm looking at a relatively smaller fund, right? Maybe generating has a pretty good previous, I don't know, 2, 3 years of historical returns relative to someone as reputable as US Energy, right? So it's a pretty big fund doing high nine figures every year, right? Maybe 10 figures. And how do I think about this when I'm making an investment, right? Between a smaller fund, which may be leading me to a higher return relative to, someone like big as US Energy.
Yeah, there's a couple of things, especially when you're reviewing oil and gas deals. One, we talked about the long-term track record. We talked about the diversification, the number of wells within the portfolio, reducing risk. But there's other sides to it too. Like, we work with the most major financial institutions in the United States, and every year before we can start to speak about these investments, we go through third-party due diligence, right? And so they're looking at us on our financials, our track record, our insurance coverages, to make sure that we are compliant to be able to speak with these clients. This third-party due diligence process is huge from a risk profile for clients, right? There's a lot of private companies, usually the smaller operators out there that are just raising 5, 10, 20, $50 million a year, that are doing it direct, right? And they're not working with a company that is vetted from a third-party scenario. It just provides a lot more risk mitigation when you're working with a major player within the space. And the other side of it that I've noticed is those smaller companies, they tend not to have the best acreage, right? Because it's very expensive. Like, the area that we're operating in, partnering with these major joint venture partners like Exxon, Shell, Oxy, that costs us $65,000 an acre to get access to. Very, very expensive, and you have to be raising a lot of money. And so there's a downside to that too, right? If you're a small player not raising a ton of money, you're probably doing a little bit more exploratory drilling in areas that can be, for baseball terminology, a home run or a strikeout. And so our core focus and what we do is to deliver the tax planning strategies and then get you predictability and repeatability on the cash flow. Kind of putting numbers behind it. Since 2009, when horizontal drilling came into play, we have a 100% success rate on every single well that we've drilled.
Oh wow, well that's pretty good. So and I'm wrapping my head around this, right? So you're saying if someone is doing 20, 30, $50 million, they have access to very few amount of those, maybe one or two. I don't know, right? How much that is actually cost. And with the technological advancement and everything, there is a high probability that they'll find oil, but there is a possibility, right, at a certain level, or probability at a certain level, that they may not find anything. And right, so though you'll get the depreciation, you can correct me if I'm wrong here, but there is a possibility you may not get any cash flow at all. Or if it's two wells, where in one you find something and the other one you don't find anything, or you find lower than what you were hoping, that tremendously affects the ROI that you were hoping to get out of it.
You got it. I mean, the question you need to ask is, what type of drilling are you doing as a company? Right? And there's really three types of drilling. There's exploratory drilling, there's step out drilling, and then there's developmental drilling. So if we take the core of a core of a known basin, right, and you're drilling assets within the middle of that core, that's called developmental drilling. Right? You're operating in an area that there's known production. We know we're going to get oil out of the ground, and it's repeatable and predictable. That's what we do. Right? We pay up to get inside those Permian Basin institutional acreage positions and deliver those results. Now, if you're doing step out drilling, you're kind of on the outskirts of that known core. You have like a 50% hit rate, but maybe half the time you're not going to actually find oil in the ground that can affect the overall rate of return. And exploratory drilling would just be like synonymous with wildcatting. You're drilling in an area that's never been produced, never been productive before, but that 1 out of 10 chance that you find oil, that's when you can get significant returns. Right? So it's a risk return paradigm shift.
Interesting. That's very helpful, Nick. Thank you. In the essence of time, let's just move on to the next slide. So I think for everyone here, probably who looked at the oil and gas investment previously or haven't, right? We'll be happy to walk you through how this actually works, right? How this plays out. If someone is asking if I want to make an investment, I'm very interested in doing that, right? How do I do it, right? What are the process? And there's this first question about the eligibility criteria, right? That's majorly towards you have to be an accredited investor. So either and feel free to correct me, Nick, if I'm wrong. Your net worth has to be above $1 million, right? Or if you are married filing jointly, you have to make 300K above in last 2 years and 200K if you are married filing. Oh, sorry, if you're filing single in the last 2 years. If you think your income was above that 200 300K benchmark or your net worth is above $1 million, you are technically eligible to invest in oil and gas fund. There is, however, an accreditation process in place. So, right, so there is a third-party company that U.S. Energy has in place. They'll review, they'll ask you for documentation, make sure you're and give you an accredited investor letter, which helps U.S. Energy to vet that you are an accredited investor and you can invest in the fund. Feel free to add, Nick, anything if you think I've missed something here.
No, that was perfect. That was absolutely perfect.
Perfect. The other major thing that people need to take into consideration is the size of the investment right here. So there are some limitations in place when you think about access business laws and AMT, right? How much money you would be investing in the fund, and how much depreciation it would be generating, right? So figuring out the right investment amount is another thing that you need to, and I think Nick, US Energy has put together a very great articles, content, PPMs, marketing material that people can get access to, can read about these things. Again, we're not financial advisors, so we cannot say that you should put certain amount and everything, but this is why we have built calculators and everything so people can run the numbers and see. Is there anything that you think are worth adding here when it comes to EBL or AMT, Nick, when people are thinking about sizing this and everything?
Yeah, I mean, it's so important, right? We want to make sure that you get the maximum benefit that you can take, right, on an annual basis. So, I mean, definitely use the calculators as you're looking at the size of investment you're looking to make. But in my experience, EBL, right, that typically applies to 500,000, right, for W-2 employees. The AMT side, oil and gas is actually a non-preference item for AMT purposes, which is great, but there is a limitation there. That limitation is 40% of a client's AMTI. And so you find that AMTI number on your form 6251, right? That'll kind of aggregate it. Let's say it's $1 million. Don't deduct more than $400,000 in an oil and gas investment, right? You can take up to that 400,000. If you go above it, you're just going to amortize the rest over the next 5 years. But it is best practice to maintain below that. Use the full benefit this year. If you have a need next year, you can do it again next year.
Got it. That's very helpful. So usually, when I'm thinking about this, the rule of the thumb is right. If it's obviously not crossing EBL, but usually 40% of your income would be, when we're thinking about stability and everything, empty comes into place.
Under that, you're pretty safe. Yep.
Yeah. Perfect. So just to put everything that we have covered so far. So you go through the process in a way that you think that you make sure you're an accredited investor, right? And then once you're an accredited investor, you think about the sizing. So suppose I think I make $1 million, I want to put in $300,000 hypothetically. Then you sign the documents, you wire the money, right? And then the process is over, right? That's what the process is. It's right. It's relatively shorter. You're not setting up any entity, right? You're not doing any hours, material participation, everything that we'll cover in the further slides. But it's just you're an accredited investor. You have the money, right? You know how much you want to put in. You sign the docs, you wire the money, and that's it. Correct me if
That's
I'm
it.
wrong.
Nope,
Wow.
100% accurate. And then you get I think we'll talk about it next, right? The deduction, the driver of oil and gas investments, and then the cash flow, which we'll also discuss here in I think a future slide, if I'm not mistaken.
but I don't need to set up anything, right? Just to confirm, right? I'm not setting up any entity, anything to get these kind of depreciation and the cash flow and everything.
You got it. Right. So most of our clients are individual investors, right? You can just exactly right. You don't need an entity to sign up, and you can invest directly with U.S. Energy, all going to your social individually or married filing jointly.
Got it. Very helpful. Wow, it's a very short process. So another, I think it's a hot question. I would put this about current administration, right? Again, they have a different take when it comes to renewable energy, and they have a very different take when it comes to oil and gas. What I think people would be very interested in knowing, Nick, where we currently stand when it comes to the new legislation and everything, right? There's been a big, beautiful tax bill that has been signed by the president on 4th of July. And where do you see we're heading with this new administration for next couple of years, and what does the future holds in terms of oil and gas investment? How should people think about this?
Yeah, and I just did like a 2 hour presentation on this 2 days ago, so I'm going to try to condense this as much as possible. There's a misconception, I believe, that Democratic administrations are better for oil and gas than Republican, right? Because historically, if you look back over the last 50 years, the Democratic administrations have had higher oil price environments, right? And just like any other market out there, the oil space is driven by supply and demand, right? The world consumes 103 million barrels per day. If supply is not meeting those demand needs, you see oil prices go up, right? And the reason being is that Democratic administrations have been less favorable to the fossil fuel space. They've been really trying to push the green
Yep.
agenda. And so they add regulations on our space, which thus reduce the US supply and push prices up.
Yep.
Now, it's not the best thing for us because higher price environment with more regulations, that means our cost to drill go up too. And so your margins don't necessarily get better, right? Given kind of exact example that we've seen over the last year and a half during the Democratic to Republican administration transition, our drilling costs have dropped around 20%
Oh,
just
wow.
from deregulation, right? The permitting process has increased and sped up. There's a lot less regulation on flaring and things like that. So, the same well that cost us $12 million to drill under a Biden administration is now costing us roughly 20% less. And that all feeds into your bottom line, right? So your margins actually get better, even though oil's not at $100 a barrel.
Wow. And that decrease in the permitting and everything is actually helping the end level investor in a certain manner, right? So I mean, that's good for them when they have to think about it, right? It's a streamlined process. They could get it relatively quicker, but the cost of getting it going down is actually benefiting them, if I'm right.
100%, right? So we have the 20% cost savings for investors in last year's fund. We have to estimate the cost to drill. And so we raised 700 million. We believe at 700 million, we can drill about 175 wells. Now, when we actually go out and drill those wells, if we see cost savings like we have, the 20%, that means that we can drill additional wells that we didn't anticipate. Or we may be closer to 190 wells from that standpoint. So all of that feeds into the investor bottom line. The more cost savings you get, the more wells that you can drill, the better rate of return that clients can receive.
And now that I'm thinking about this, and I'm circling this back to the first slide when we were discussing about relatively smaller funds versus larger funds like U.S. Energy. So you're saving 20% on, I don't know, two wells. It would be a fraction of a difference. But when you're talking about big numbers, like again high nine figures, maybe 10 figures, then it's a meaningful difference when you think about it.
Huge. I mean, on a smaller operator, let's say it's a $10 million raise and they're saving 20% on cost. Well, you go from 10 million to 12 million, right? That's not really going to move the needle too much on a well count scenario. When you're raising so much and all this capital, you're saving 20% of 700 million is a lot,
Yeah,
right? More wells going into the bottom line.
perfect. Well, that's very helpful, Nick. Regarding I think regarding IDC tax deduction reinstated, you wanna share more on this? How should people
Yeah.
think about this?
So IRS code 263C, and that's what oil and gas falls under. IDC stands for intangible drilling costs, and those are the costs that you're able to deduct in an investment year. So that's the cost of drilling an oil and gas well that don't have any depreciation schedule tied to it. In our funds, it's historically been around 90%. So that part of the code has been there since 1914. So well over 100 years. It's gone through 100 years of different political changes and everything else. And it's always up for discussion, but it always gets reinstated. So again, the IDC is reinstated on a go forward basis. Um, it's pretty much a lot to be there because if you were to repeal that part of the tax code, you would likely see oil jump significantly, right? Because that is what incentivizes clients to invest in the oil and gas funds here domestically in the United States. And no matter what side of the aisle you are on, there is a feeling of being pro domestic energy, right? We don't want to be reliant on other countries for our energy needs, and so that's why that part of the code has been there for over 100 years, right? They want to promote domestic energy, they want to promote investment into the space, and so that the IDC is hasn't changed, and we don't anticipate it changing anytime soon.
Got it. Regardless of whatever Democrats, Republicans in place, you're hoping that's going to stay at 90% for foreseeable future.
You got
Got
it.
it. Perfect. Moving on to next slide. So benefits, right? So we talked about what the process is, but we talked about, right, what the new administration thinks about it. But, just to, I think what audience would be interested in knowing is what's the end level benefit, right? I'm
Mhm.
doing this, right? It seems very good on paper, but what are the other things that we haven't covered when it comes to benefits? If I'm putting again $100,000, right? What am I getting out of it? And that's I think what we should cover in the slide. So I'll go over the tax savings piece of it. So again, if you're putting $100,000, and as Nick was talking about in previous slide, that historically we have seen people have been able to deduct their AGI by around 90 cents on a dollar. So on 100K, you're looking at 90K worth of depreciation that you could take all in year one because of intangible drilling costs. That's the incentives from the Congress that they are able to. They're letting you deduct 90 cents on a dollar in a form of depreciation against your federal AGI. Now, there are a lot of states who give out the same. They do accept IDCs, like New York, where you could also get the 90 cents back on the state level. But there are some states like California who don't accept IDCs. Nick, do you want to add something here, right? In terms of, I think there are a lot of states. I don't remember all of them, which offers IDCs.
Yeah, there's a few. So California just instituted it last year. That was a big one. Michigan and South Carolina and New Jersey. Those are the states that I've run into that give you a little bit of trouble on the deducting the IDCs on the state level. The rest of them are pretty good about it. Like I live in New York, I take it every single year against the state side. But New Jersey, South Carolina, Michigan, and California, the four that I've run into.
Got it. So essentially, if you're putting dollar, right? So you're in New York, and you're probably going to be paying 50 cents on a dollar in taxes because again, New York federal plus state. Maybe you're in city as well, right?
I can
So
tell you 51% from personal experience. Yeah,
yeah, it's a well. You're also not getting the California sunshine, so there's
also
that.
true. Double whammy.
Yeah. So you're putting a dollar, right? You're getting 90 cents of depreciation, and you're saving essentially 45 cents on a dollar in taxes, getting, depreciation on federal level and state level, which is pretty high when you think about it. And there is going to be access depreciation, right, Nick? So there's going to be another 10 cents, which is going to be amortized over the course of from year two through year six. Has its own depreciation schedule. But in year one, you are able to take the depreciation against your active income. Now there is a requirement, right? GP versus LP that will cover, right? Why they let you take it against your active income. But if you're talking about the numbers there, the major incentive is that you're taking the depreciation, right? 90 cents on a dollar in depreciation deduction in year one. The other benefit is the income stream, right? And this is something that again I've been very careful about my words about it. That for compliance reason, I
Sure.
cannot commit to you a particular percentage that you'll be getting every year and everything. again, it's a commodity, volatile, right, relative to different things. Where you buy a rental property, you have a different occupancy rate. If you're buying solar, you know how much electricity is going to generate for how many sun hours, all those things. But when it comes to income stream, right, Nick, what have you seen historically, right? Again, nothing guaranteed, nothing promising, but what have you seen? What are you expecting? And people invested last year.
Yeah.
What are you looking at?
Yeah, so I kind of look back, right, over the last 5 years, which is where we've been really working in the Permian Basin, working as a joint venture partner with Exxon, Shell, these major firms. We've typically seen it take around 4 to 5 years to get a 100% return of your original investment. So you kind of break that down using your example. You invested $100,000 this year, and based on that tax bracket, you saved $45,000 in taxes, right? So that's a 45% return. Right? That 45 grand was going to go to Uncle Sam. Now you get to keep it, right? You can actually reinvest that back in the market and allow that to grow for you over time. The cash flow process will begin in the first quarter of 2026. And every quarter, what you get is just a distribution, right? The distribution will be based on how many barrels of oil did you produce for that quarter and what the underlying price of oil is. Now, the variable of production, we've been very predictable and repeatable. Like every well that we've drilled has been right on our type curve. And so you kind of take that variability out of the equation somewhat. We cannot control commodity prices fully. We'll talk about it later on the risk profile, but we hedge quite a bit. But from our experience, 20 to 25% a year in cash flow over that first 4 to 5 year period. And the life of these assets, the life of a well in the Permian is going to get you about 10 years. So you can receive quarterly checks all the way through a 10-ish period from an overall rate of return standpoint.
Got it. And just to confirm, right? So when we're talking about cash and cash return over the course of 4 to 5 years, and I'm thinking, right, I'm gonna get my money back. We're not talking about the depreciation deduction that I've taken. Other than that, we're all talking about purely cash on cash return. Um, and is that income, right? Is that passive? Is that active, Nick? Because that's another question, right? How easy or how difficult it is to write off that income, right? Usually
Yeah, so it's considered working interest, right? So it's not subjected to self-employment tax, but it is
got it,
taxed at ordinary rates. So let's
got it,
say next year you get, for easy math purposes, let's say it's $10,000 in income. What you do get is it's called the depletion allowance, right? So because these are depleting assets over the 10 years, you're able to essentially shelter your income by around 20% every single year. And so if you earn $10,000 in income on your K1 that you receive, you'll see the $2,000 of depletion roughly, and your actual taxable income is only 8,000. So it's one of the rare investments out there that give you this massive upfront tax savings and deduction in the first year, give you a very high yielding investment that's also quite tax efficient.
got it. So you're looking at 90 cents on a dollar in depreciation in year one. You're looking at additional 10 cents that's on amortized from year two through six. And you're also looking at a 20 cents in depreciation because of the depletion allowance. So all in, right, every year when you're taking an income stream, right, that's coming out of the fund, a lot of it, right, again, how depending on the income, right, you're looking at a decent amount in first couple of years, right, or in first year, where a lot of the income is just deducted, right? You're not paying taxes on because of the depletion allows, and plus the depreciation that's coming from year two through six with the depreciation
You
schedule.
got it. And that continues all the way through depletion. Like it doesn't stop after your basis reaches zero. The depletion allowance continues all the way through the life of the fund.
Got it. And in terms of over the life of the fund, right? Let's call it 10 years. That's what we talked about. And I know we talked about that. Historically, we have seen people getting their money back over the course of 4 to 5 years, just cash and cash return purely. What have you seen historically, right? Over the course of 10 years, people getting I don't know, 120% or 30%. What are we talking about here?
Yeah. So when we structure these funds, right, we invest in these assets. Our model, right, we won't even put an asset into the fund if it doesn't try to deliver a 1.5 to a 2x over the life. at current prices, right? So kind of when we structure these investments on a $100,000 investment, we believe over 10 years we can get 150 to $200,000 back in cash flow over the life of that fund. And that is not including that $45,000 of tax savings you took in the first year. Right? Some funds will do better than that if prices go up during that 10-year period, and some funds may underperform a little bit if prices retract from that point for the 10-year period. But when we structure them in the year, that's our target and that's what we're focusing on.
Got it. That's pretty good when I think about this, right? Depreciation plus 150 to 100%. Again, nothing guaranteed, but it's a
Yep.
pretty decent return. Essence of time, there is another that I think is a big value proposition, Nick, is a preferred return. Now, if you were to explain to someone in a very simple terms what is a preferred return and how it is actually a value proposition to an LP or even a GP, right? How would you explain it?
Yeah, I think the easiest way to explain it is when you're investing with a company, you want to make sure that the GP and the LP interests are aligned, right?
Got
That in order for the GP to earn fees and revenue, that the clients are earning the rate of return that is expected, right? And so we've structured the investment to try to do that. And so the preferred return, U.S. Energy earns 15% of all revenue coming from the fund on a quarterly basis,
got it.
unless we're not hitting at least a 12% annual rate of return for clients. So let's say oil prices fall, right, and revenue drops from 20% to 11%. Well, we're not entitled to any of those fees, right? We forego all of our fees, 100% of all revenue goes to clients to get them above that threshold. So our interests are aligned. In order for us to continue to grow, which we have been over 45 years, and earn revenue as a company, our investors need to have performance. Our investors need to get a decent rate of return as well.
Got it. So if I'm understanding this right? So GS Energy is not gonna make anything unless the LPs are looking at a certain return. And that certain return, depending on when you are investing, right, could be 20% a year for 5 years. So that means US Energy is not going to make anything unless I make my money back, right, over the course of 5 years, right? It's just, I know it's divided over the course of 5 year or 20 years. So if you're not hitting above 20%, I'm essentially going to get my money back, and then US Energy, and this is sort of a, I think serves as a, I don't know, catalyst to perform better and everything, but I don't think there hasn't been any issues so far when it comes to this, right? That you have been able to, I mean, you have 100%. Sorry, good.
No, honestly, and we built it in. Like if, once we go on to the next couple slides, like the risk profile, right? When we're hedging out, so we have to calculate our cost to drill, right? And at what price point are we hitting those rate of returns? And so we take on hedging contracts, just like many people may do, where you have a ceiling at $80 a barrel and you have a floor at 60, right? So if prices trade within that range, we're going to get paid at that price. But let's say from a downside risk perspective, if oil drops to 40, right, well, we can enact that swap where over 50% of our production is still going to be paid at 60. Right? So we've built in these mechanisms to try to mitigate downside risk for our investors. I mean, that's very important. And selfishly, we do it for our corporate level as well because we're the largest investor in any one of these funds. Like last year, our co-investment was 120 million alongside of our partners. This year, we're targeting 150. Right, so we're getting protection from corporate level fluctuations as well as, more importantly, investor level fluctuations.
I mean, if I was investing, I want to make sure you guys make money as well, because again, incentives have to be aligned, right? It's not a nonprofit business. Moving on to the next slide, I think this is something we've been holding off. Important thing to talk about is active versus passive, right? So there's this, taking it a step back here, right? IRS categorizes income into two buckets: active income, passive income. So W-2, S corp income usually, right? So oh, there's this question from Dave that I'm gonna put it on the screen. Nick, you want to answer this one?
Yeah,
Um,
Dave, great question. So the hurdle rate is 12% per year for a 5-year period. So we have to be hitting over that 12 on an annual basis in order for us to earn our fee as a firm?
Uh, Keep them coming. Good questions.
Very
Um,
good.
yeah. So the active versus passive again on that, right? So W-2 business and S corp income, any activity in which you're, putting certain amount of hours, right? You're getting paid for compensation, even stock. It's considered active, and it's usually hard to write off active income because you have to be active in some other business in order to generate losses to write off your active income. So the IRS categorizes income in active and passive because they want you to have active losses to write off active income and passive losses to write off passive income. Passive is simple, right? If you buy a rental property, you're not a real estate professional. It generates rental income. That's passive, right? It's easy to write off passive income. The rental property generates a lot of depreciation, but you cannot use the depreciation against active income like your W-2, right? That's one example. So it's usually very hard, right? And the crux here is that it's usually very hard to write off active income. But in oil and gas, right, the incentive for IDCs is not just about you're getting 90 cents on a dollar in depreciation, but it also allows you, right, without putting any hours, right, and people do factor in time value money, right? They want to make sure that the time is worth something, right? So they're not spending 100 hours, 750 hours, or 500 hours in oil and gas, right, in order to take the IDC against their active income. Nick, you wanna add something more on the GP status here?
Yeah, I think it's one of the unique things for oil and gas. Right? I was told a long time ago, and it resonates, that the one thing we can never get more of is time. Right, so making your time valuable, and oil and gas can do that from a tax planning scenario. Right, you're not going to be working a well to be able to get this active deduction. So
Yeah,
how the code reads is that most 99% of our clients come in as a general partner, right? So this general partner entry allows you to take that deduction against active income. You're a general partner for a period of about 9 to 12 months, right? Once all the wells are completed, you're automatically converted to a limited partner from that point all the way through the life of the fund. So that general partner risk lies with you for that drilling phase, typically 9 to 12 months. If you look up the definition of a general partner, it can be a little scary, right? Because technically that means that you're at risk for more than the amount that you invested. And I can't hit this point hard enough. This is why when you're doing these investments, you want to work with a reputable firm that's been around a long time, that has insurance coverages and raises a ton of money, because that risk can be quite a bit if you work with the wrong partner. So for us, almost all of the drilling that we do is working with major E&P firms, Exxon, Shell, and Oxy. They typically have about $180 million of insurance coverage from the first layer. It's called subcontractor drilling insurance. The second layer of protection would be we carry a $50 million blanket policy through Chubb. And then the third and most important layer is we indemnify clients during that GP phase, where we pledge the entirety of our company and our assets in front of you in case anything were to ever go wrong. So in aggregate, you have close to $500 million of insurance that cover that GP risk during that drilling phase. Right? In our 45-year history, the biggest insurance claim that we've ever had is a $250,000 workers' comp claim from an injury on a well site. So we're drilling in an area of Texas that's very pro energy, developmental drilling, very safe. We mitigate that general partner risk, but all of that is done so that you're able to take this deduction against where you want it, which is the active income area.
got it. So it's actually so your title on the books is GP, general partner, right? I mean, you're technically on hook for liability, and then Nick has covered how they're mitigating that risk, and we have another slide that covers the risk area, right? But other than that, there isn't anything there, right? In order for you to take the depreciation against active income, it's just you stage it. So, and the interesting thing that here is, Nick, that you're only GP for 9 to 12 months, and that's it, right? You become a limited partner after that. So it's not that you're going to be GP for the remainder length of the fund, right? Whether it's 10, 15 years, you are only GP in the year you're taking the IDC against your active income. And after that, you become an LP, right? They don't want you to be
Your
GP.
first year K1 will show you as a general partner, which will only show that deduction amount, which is what you're taking. And then every year going forward, that K1 will show you as unlimited partner.
And just for everyone's clarity, right? So the limited partner is essentially not on hook for liability. So if I'm on hook for whatever my capital contribute or whatever my investment is on top of that on hook, but when my status turns in from GP to LP, I'm not on hook for things, right?
You got it.
Perfect. Sounds pretty good. Risk, and this is something that every time that I'm on a call for oil and gas comes up, right? You want to cover what are the risks. It seems very good if an investment when we just talk about the numbers, but what's the catch, right? So again, volatile commodity prices. I think you have covered very well the GP partner liability, but again, anything you want to add on GP, and then we can cover the other points of dry and underperforming wells and the commodity prices.
Yeah, so I mean, most clients think general partner liability is the biggest risk. It's a risk, but to me personally, been doing this a long time, there, it's not the biggest risk in this investment. You kind of look back at the history, right? So for a syndicated oil and gas deal, syndicated is like us. We talked about how we go through the due diligence channel and work with major financial institutions. There's never been a case law in U.S. history where a syndicated oil and gas deal asked general partners to contribute more than they invested. It does happen, and I've seen it happen a lot on the private side. Like if I was Nick White LLC trying to drill a well in my backyard and asked you to invest with me, well, small company, no insurance coverages, that risk is real. But from what we do on the syndicated space, we haven't seen it, and we have protections in place. Dry and underperforming wells, that goes back to my first point. You want to ask that sponsor what type of drilling are you doing? Is it wildcat? Are you drilling in an area that's never been produced before, looking for a home run return? Are you doing step out drilling, where you're kind of on the outskirts of a known basin, or are you doing developmental drilling? So we have a 100% success rate since 2009 when horizontal drilling came in as a primary technology. We're doing developmental drilling. The risk is there technically, but we mitigate that just by where we operate. To me,
Yeah,
the biggest risk is commodity price fluctuations. We can't control those fully. We try to mitigate those and mitigate that risk pretty strongly by hedging 50% of our production. But to me, being that we don't have total control over that, that's a bigger risk than general partner or dry underperforming wells.
got it. So essentially, right, again, three things there. So I mean, riding off the dry well space, right? If you're working with US Energy, so far you had 100% success rate, right? So there's a very low probability, because I get this question a lot that there's a possibility you may not find something, but that's the case when you're working with the smaller level funds. But when you are drilling again 100 plus wells, 175, you're definitely going to find it. The price in the market would dictate how much it's going to be worth, right? That would drive your cash flows. And I guess interesting to see that you have an 100% success rate, because then you're very sure about the fact that you're going to find it again, that it's the price thing. Regarding the GP, it's also interesting to see it's very right time limited, right? So you're not on the hook for things for, because usually at the investments that I've seen and the other structures that I've looked into, you stay on the hook for things, right? You have to. There isn't anything, there is no free meal. So you are actually stay on hook for liabilities in other structures that I've came across, which
Yeah.
is an interesting to see that you are only on hook for liability. You become an unlimited partner after that, which means the income that is generated is passive, right? And you are a passive investor inside the fund. You're taking call it a mail money every year, that you're not doing anything, right? You don't have to worry about anything. So you take the money and just put it in the bank account, do whatever you want to do with it. Um, that's yeah. So last thing, I think we're way over time. I Let's just quickly go through this real life case study. So we have John here. John is from New York, married filing jointly. Now, assuming John made $1 million in income within a calendar year, John is interested in doing something. There are a couple of structures out there, but John is not interested in putting any hours in this space. John is not interested in taking liability for things for 40 years, 30 years, 20 years. John isn't interested in going down the rabbit hole, maybe setting up an entity, talking to an attorneys, and going through a very complicated structure. John is already an ability employee, wants to make his life simple, but doesn't want to pay a lot of money to Uncle Sam. So John's, if he doesn't do anything, John owes $500,000 in taxes, right, give or take in New York. Again, highest effective tax rates. John decides to put $300,000 in oil and gas investment, right? So on that, assuming 90% math, we're looking at $270,000 in this depreciation, 90 cents on a dollar in depreciation. That means John is going to reduce his AGI from $1 million to call it what, 730,
Oh,
if I'm
730. Mm-hmm.
not wrong. So that's what John is looking at. So essentially, on that 217 depreciation, John essentially saved, you know, 50% on that would be right. So you're looking at what, $135,000 in taxes in year one. That's what you're looking at. That's John said. And if we talk about the income figures here, right? Right, John is also expecting to recoup all the money, so all the 300K back over the course of 4 to 5 years. That doesn't mean that John is only going to take 300K. John might be looking at 450 and 600K back. But the essential piece here is that John is looking at probably, John is looking at, saving 45 cents on a dollar in savings in year one. And John is looking at an upside of getting his money and more back over the course of 4 to 5 years, and essentially over the length of the fund more than that. The piece, and I'll let Nick add more colors to this, is the way I think about this, Nick, is if you give a dollar, which is a very big tax play out there, is you give money to DAFs and donors, patrons, and a private foundation trust, a 501(c)(3) charities. Again, you're doing it for charitable purposes. That's totally fine. It's your personal. But if you're doing it for tax mitigation, you gave them a dollar, you got a dollar worth of depreciation, right? You use
Mm-hmm.
it, it has its own limitation, 30%, 50% of your AGI, depending on what you're contributing. But everything aside, um, you're never going to get anything out of it back, right? It's not, it's growing, but it cannot generate anything additional for you. You just lost it, right? Where in oil and gas, right, you get a dollar worth of depreciation, right? Close to a dollar worth of depreciation in year one. You're going to get all of the dollar back, but close to a dollar worth of depreciation in year one. And plus you have an upside or more to make all of your money and more back, right, in form of cash flow. So you have a hope, right? Again, we talked about how to mitigate these risks and everything, but you have a hope that you don't have in other cases. If I'm, feel free to add anything like that I
Yeah,
missed.
no, and I mean it's one of the very rare investment vehicles out there, oil and gas drilling funds, where it's not only this amazing tax planning tool, right, this year, but it's also a very strong investment opportunity, right? So kind of just from a 10,000 foot view, being able to take a deduction, realizing these tax savings, but then also making it a reasonable to really good rate of return over the life of the fund. It's hard to find both of those, right? You make a very good point on these charitable gifting, right? You get a feel good return, which is amazing, but an investment rate of return isn't usually, it can't be there, right, for those charitable gifting scenarios.
And that's why it's a, you need a base level scenario to compare it against, right? So how would I know it's better and everything? And it's when you wrap your head around it, that I have a base level scenario and I'm comparing oil and gas to that. How is oil and gas better? And that's when you see the actual return, right? You see the underlying value proposition. There's a question, another question from Dave, which is a good question. What happens to the terminal value of the wells?
Yeah, another good question, Dave. So the overall rate of return from these type of funds, right? You're getting a tax deduction, tax savings in the first year, and then your overall return is based on the return production over the 10-year life. So by year 10, there's not going to be really anything left in the ground for you to take out, roughly, from a cash flow perspective. So at that point in time, the fund is capped, issued final K1, and the fund is done. There's never any asset sale within this type of fund, which is a benefit because there's never any recapture event you have to worry about, right? You took the deduction, you're going to get cash flow, all the way through until the wells run dry, and then the partnership has concluded.
Got it. Um, Thank you so much, everyone, for joining. We're open to questions. Again, we ran over time. I do apologize for that. There were just so many things that we wanted to chat about. They
Sure.
had very good questions. Again, we're happy to take any questions that you may have for next minute or two. Then we'll call it off. One question that is from me, Nick, is how do I think about it? Can I transfer my ownership in the fund to someone else, right? That's a question you get in other things, right? If I want someone to inherit it or whatever, I want to. Is that something possible? Is that something not? Right? What's the reason? All those things.
Yeah. So I mean, I deal a lot with estate planning, right? And there's a lot of clients that gift this asset. So on an annual basis, you can do that. Most of our clients have a TOD form attached to their investment. So, God forbid something were to happen, there is a designated person that can transfer that ownership. You can transfer it to anything. A lot of people come in individually year one to take the deduction individually, and then they transfer that investment to a trust or an LLC, no problem. There's not really any weird things you have to be wary of. We transfer assets all the time.
Got it. And it's actually linked to the Dave's question, right? So you're investing the money, your GP in a calendar year, you're taking the depreciation, you're taking the cash flow, whatever it generates, and then after that, when there isn't anything left in the wells, right? They're technically dry, right? Whatever, or maybe the quantity is just way low and the price in the market is way low. It just doesn't make sense because your cash flow, you're paying out of pocket to drill it. Then you just close the books and you issue a final K1, and then that's it. So no depreciation recapture, right? No other thing that people have to worry about, or maybe dispose the asset that they have to worry about, and other things. It just becomes a very clean structure that you get done with.
Yep, exactly. No tax liability you have to worry about on the back end. It's not that you're getting it now, but you're paying that back later. It's very clean. Is exactly what I would agree with.
Got it. Well, that's very helpful. Any? Oh, there's another question from Dave, which I think we should. So if you transfer the asset in year two, and the value is the value of the initial investment minus depreciation, 100K with 90K depreciation. Is that 10K asset value in year two? It's a good question.
It's a fantastic question. So no, so it holds par value on a statement. Now we do some really creative things, and without getting too into the weeds, we do creative things with the valuation side of oil and gas. So the SEC forces us to add marketability and minority interest discounts on the reserves, right? So we do a lot of Roth conversion planning too. Like, a client enters through a traditional IRA. In year two, it's valued at 50% of what it was. Then you can do your Roth conversion, pay about half in taxes to do it, but all cash flow is going to go into your Roth IRA. So if you were to transfer a gift and asset, you can use that to your advantage. You know what I mean? Where you can come in, take this deduction personally in year one, and then year two, I could gift that asset away to my kids, and I can show a value for the gift exchange at 50,000. Right. So there's a lot of tax planning that you can use from that side of the equation.
And whatever income then it generates, it's not using my gift and state tax limitation, right? Again, it's because I already passed it on at the time when it was half of the value. Well,
You got it. So there's so many cool things that you can use oil and gas for. It's not just like most people use it for W-2, 1099, but for estate planning or performing Roth conversions, it's a great tool to have in the quiver, arrow in the quiver.
got it. Well, I think we should call it a day. It's been a pleasure having you here, Nick. Really good insights, really helpful. I mean, it was helpful for me as well. Been pitching oil and gas for several months now, but it's been very helpful for me. Thank you everyone for joining. Really good questions, Dave. And feel free to schedule a call with us if you want to learn about oil and gas, solar, and other products that Valor offer. We have Nick's email here. So if there's any question that you may have for Nick, feel free to send an email to Nick, chat about it. And you have my email, you have a link to schedule a call. We have another webinar coming on July 30th, which is going to be about maximizing investment value of a diversified portfolio tax mitigation strategies. Um, Till then, thank you so much for joining. Have a very nice day, and I'll see you in the next webinar. Thank you, Nick.
Yeah. Thank you, everyone.